So again, operating margin, how much? Productivity or efficiency, how often, or how much do I have to spend to generate sales? Okay, so those are the second and third drivers. So tax rate, operating margin, productivity. Okay, productivity typically comes from the balance sheet. Operating margin comes from the income statement. So then we're going to have what we're going to call the second level drivers. These are the top level drivers, or what we're going to call the first level drivers. All right. Second level drivers is what drove operating margin from the income statement. All right. So on an income statement, three things drive operating margin. One is your gross margin, it's percentage of sales. Two is your overhead or SG&A as a percentage of sales. And three is your depreciation spending as a percentage of sales. Gross margin minus SG&A minus depreciation equals operating margin. So those are the three things on the income statement that will explain the operating margin. When we look at the balance sheet, three things, the second level drivers will explain our overall invested capital to sales ratio at the balance sheet. How much we spend on working capital as a percentage of sales, how much we spend on property, plant, and equipment as a percentage of sales, how much we spend on acquisition premiums, known as goodwill, as a percentage of sales, right? And as we know from the book, goodwill is operating. So you add those three things up, working capital, PP&E, and goodwill, you get invested capital, operating invested capital, okay? So those are the three things that will drive productivity, okay? And so that's what we're going to be doing here when we analyze the trees. All right, so those drivers, the second level drivers explain the first level drivers, the first level drivers explain the ROIC. Okay? Second statement we're going to look at is called CFI, cash flow available to investors. Now you just converted CFI as part of your homework assignments. Okay? So you should understand that we've now taken the company's financials and we've put them into a Modigliani-Miller format, and one of the pieces of Modigliani-Miller is cash flow. So there's 4 boxes of cash flow, all right? The first box is called your operating cash flow, which is also known as free cash flow, okay? So what are the drivers of operating free cash flow, okay? And there's going to be 2 things there. One, what's your gross cash flow that you generate from the income statement, and 2, how much gross investment has been made back into the balance sheet. Okay, the net of that's your free cash flow. So we're going to try and understand that, what's going on with the firm. Okay, next we're going to look at the non-operating cash flows of the business. We've separated out the operating and non-operating. So what's driving the non-operating cash flows? How much of those non-operating cash flows are coming from the income statement, and how much is coming from the balance sheet? Okay, because remember, same process when we converted the statements, cash flow is income statement minus change in balance sheet. So we're going to be looking at each of those as we go through the 4 sections. Those 2 together, when we add up, was the CFI, the cash flow available to the investors. And then what did we do with that cash flow? Did we pay it out, or did we have to go borrow it because it was negative? So then we're going to look at what's called the financing or funds flow side of the CFI, which is basically the debt and the equity. Okay, so basically, did the company issue or repay debt? Did the company pay back interest? Okay, assuming it had debt. So what were the cash flows to the debt holders? And then what would be the cash flows to the shareholders? Same thing. Did the company buy back its stock? Did it pay out dividends? Did it issue new stock, common or preferred? Okay, and remember that these 2 sides of the balance sheet, the operating and the non-operating cash flows, have to equal the debt and the equity cash flows. So that's going to be one thing that you're not going to like about what we're going to do, which is probably what you didn't like about your previous assignment, is that in other classes and in many companies in the real world, they don't make you balance the cash flows, meaning you just do 1/2 of the equation. You do the free cash flow and you stop, all right? In this class, any cash that's generated, we're going to look to see where it went. It's going to be balanced. Because if you generated cash, you did something with that cash on the financing side, so where'd it go? Who'd you pay it to? All right. If you needed cash, then where'd it come from? Okay. We're going to balance out the statements. It will make you better at what you do. Okay. And a better understanding of what's going on with the firm. And we can use these 2 approaches, understanding what's going on with ROIC and understanding what's going on with CFI, to get a good picture of just about any company. Okay. So that's what we're about to do. Right. So I'm going to start out with Starbucks, some historical data with an ROIC tree, just because I think here everybody's probably heard at, has some understanding of Starbucks. Probably given them a lot of money over time. Okay? And so when we do ROIC trees, we are going to do 5-year ROIC trees here. It's just an arbitrary time frame that I have shown you. And so the most current ROIC is going to be on the right. The most oldest of the 5 years will be on the left, so it kind of goes from left to right. And you'll see, starting on the left-hand side of the screen, starts with what's called EOY ROIC. EOY is an acronym for end of year. Okay, so that means the end of their fiscal year. Right? So, latest results. Now, what you're going to see on this table here, laser pointer, is in 2017, Starbucks had an ROIC end of year of 48.3%. Okay. Now, for purposes of today, I'm going to focus on year 1 and year 5. Okay. However, as we go through your assignments and group project 2, when you do a presentation on Parker Hannafin, which is going to be the company you're going to do the 5-year historical analysis on as a team, okay, you're going to be responsible for all 5 years. Okay. So right now the training wheels are on when we look at year 1 and 5, I'm keeping it simple, but eventually what happens in between matters as well. Okay. So year 1, their ROIC in 2017 in this example was 48%, 48.3%. 5 years later, it was 23.2%. That is a 5-year change of negative 51.9%. So basically, Starbucks ROIC got cut in half over 5 years. So with the first level drivers, why? That's what we're going to answer. Those 3 first level drivers are going to explain that drop in ROIC. Driver number 1, tax rate. Okay. In 2017, Starbucks paid a tax rate of 33.2%. In 2021, Starbucks paid a tax rate of 21.6%. That's a 34.9% 5-year change in their tax rate. So the question is, did that tax rate going from 33.2 to 21.6, would that help the ROIC or would that hurt the ROIC? Yeah. So is tax rate the reason why the ROIC fell? Clearly not. Okay. So if I'm thinking about what would be driving the ROIC, paying less in taxes should make your ROIC go higher. Right? So the first thing we would say is tax rate's not why their ROIC is falling. And by the way, taxes should be helping the ROIC of Starbucks. Okay. So now we're going to look at drivers 2 and 3, which means if we take out the tax rate, go right up, and you're going to see the pre-tax ROIC. This is basically the operations of Starbucks. What do they do when they sell you a cup of coffee? Okay, and we can see that on a pre-tax basis, their pre-tax ROIC went from 72% to 29.6%. So all of the drop in the ROIC was in their operations. Had nothing to do with taxes. Everybody clear so far? Pretty simple. Okay, so now we're going to look at drivers 2 and 3. Okay, driver 2 is their operating margin. Okay, basically, how much profit do they make when you go buy a cup of coffee? So from an operating standpoint, in 2017, their operating margin was 18.5%, which means for every $1 of sales, they made 18.5 cents of profit. In 2021, when they sold $1 of coffee, they made 16.8 cents in profit. Is that better or worse financially? It's worse, right? Should that help the ROIC or hurt the ROIC? That should hurt your ROIC. So if you're making less at every sale, your ROIC is going to be less profitable, less ROIC. So we've identified one of the reasons why the ROIC went down. Their margins went down. They're making less at every sale. That's driver 2. Okay. Driver 3. How much are they spending to generate $1 of sales? How much are they spending to sell you the coffee? So in 2017, the way to read this number is to generate $1 of sales, Starbucks had to invest in their balance sheet 25.5 cents. To generate $1 of sales in 2021, Starbucks had to invest 56.6 cents. Is that better or worse? That's worse. They're now spending twice as much to sell you the same coffee. So their productivity has worsened. Does everybody see that? Does that help or hurt ROIC? It's going to hurt ROIC because you got a whole lot more investment for the same sales and profits. Yes?
So with this tree, if like the cash tax rate is not like the reason why ROC is like being very, it doesn't nullify all the rest of it.
It doesn't nullify the other two because the pre-tax is the pre-tax. But what I want us to do is I still want us to talk about taxes because taxes affect a company, right? So part of the answer in this analysis is one, mathematically understanding what's going on, but number two, why? That was a big part of EIC. Like, I don't want you to just plug and chug a number. Anybody can solve some equations, but why did the tax rate go down? All right, what caused that? What happened between 2017 and 2018 that caused Starbucks to pay a lot less in taxes? Anybody know? Yeah. Yeah, so Trump, under his administration, got Congress to lower the tax rate. And so the lowering of the corporate tax rate basically is why this went down. In fact, if I remember, I think it was like for 10 years. Like at the end of 10 years, these tax rates, I think, expire, and then they actually go back up. So as a matter of fact, you're going to see a big political fight over this coming up in Congress in the next couple of years about whether or not to renew all the tax cuts that were made back in 2017. Okay? But that being said, cash tax rate went down. We'll talk about why for any of the numbers, but that should have helped. Pre-tax ROIC worsened. That's where they really got the drop in their ROIC. Why? Because their margin went down. They're making less than every cup of coffee, and they're spending more investment to sell the coffee in their stores. Okay, so that's the first level of analysis. Those are the three drivers. I will mark them out here by pen. Driver 1, driver 2, driver 3. And this is mathematical. Okay? So let me talk to you about drivers 2 and 3. Okay, just so you understand what's going on here. It's algebra. Okay? Operating margin is profit divided by sales or revenue. P over S, for short. Return on invested capital, which is what we're trying to do, was ROIC. It's profit divided by invested capital. So that's ROIC, P over IC, and operating margin is profit divided by sales, EBIT divided by sales. Okay? So just conceptually, let's go back to 9th grade. Okay? Some of you might have done this in 8th grade. But basically, you multiply P over S by blank over blank, and then you get P over IC. So if I wanted to connect P over S to P over IC, what would I multiply it by? P over S by what? Times what? S over IC. S is sales. IC is invested capital. It's the ratio of sales to invested capital. That's productivity. The important point here, this multiplication sign, equal weight. They are just as important in explaining ROIC. So what algebra has told us is two things drive ROIC. P over S, profitability, how much you make. S over IC, how much you have to spend to make it. Okay? One's an income statement driver, one's more of a balance sheet driven driver. Right? But that's the point. There are two things that explain ROIC. We're just putting them on the tree. Just following this algebraic equation, breaking it out. Now I've made one change on this tree that you should be aware of. Is that driver number 3 on this tree is reciprocal. Instead of S over IC, I did IC over S. This is IC over S. So basically, and this is P divided by S. Okay, so these are the two parts of the algebraic equation. All right, you might say, gee, why did he do that? Why did he take the reciprocal for the second part of the tree? And the answer is because I want everything per dollar of sales so that we can add that up. Okay? As a matter of fact, the other reason I do it is because when I talk to companies, they don't think in terms of dollars of investment. Everybody at a company thinks in terms of dollars of revenue. So it's just easier to talk in terms of dollars of sales. But it also allows us to add the tree up across the tree to keep the denominator constant. That's why I also do that. So technically, it's P over S times 1 over IC over S equals pre-tax ROIC. Okay, the way the tree is set up. But the point is, lower invested capital sales is better financially. I don't spend as much to generate sales. I'm more efficient. Okay, higher is better for operating margin to ROIC. I make more money when I sell something. But those are the two drivers of the operating performance. Everybody clear on that? Second level drivers. Why did the operating margin, which was in 2017 at 18.3%, fall in 2021 to 16.8%? Okay, now we're going to go to the income statement. And I told you there's three things in the income statement that drive operating margin. One, gross margin, minus spending on SG&A, minus depreciation, equals operating margin. So those second level drivers, these three things, explain the change in operating margin. Okay? So let's talk about gross margin. Gross margin is the difference between the price and the cost of goods sold. Price minus direct cost is a percentage of sales. Okay? So basically, how much are they spending in the actual cup of coffee? Right? So in 2017, 35.3 cents is the margin left after they paid their cost of goods sold. In 2021, 34.1 cents. Is that gross margin falling or rising over 5 years? And if my gross margin's falling, what happens by operating margin? All things being equal. It would also be falling. So one of the reasons why the operating margin fell is because the gross margin fell. They're making less every time they sell a cup of coffee. Difference between price and cost. Okay? Driver number two, spending on overhead, spending on selling, general, administrative, those indirect costs during the period. In 2017, they were spending 13.8 cents per dollar on SG&A. In 2021, they were spending 13.4 cents per dollar on SG&A. Is that better or worse to operating margin? That's better. So that's not why the operating margin fell. It wasn't because they're spending less than SG&A. Driver number three. In 2017, they were spending 4.8 cents per dollar on depreciation. In 2021, 5.2 cents. Better or worse to operating margin? If you spend more in depreciation, does that help your operating margin or hurt it? Makes it worse. Hurts your operating margin, and therefore hurts your ROIC. So if I look at the income statement drivers, two of the drivers hurt the operating margin, one of the drivers helped it. Now let's talk magnitude. How much did each impact it? 2017 to 2021, operating margin 35.3 to 34.1. That dropped about 1.2 cents. Okay. Depreciation, 4.8 to 5.2. That worsened by about 0.04 cents. So I got about 1.6 cents of worsening from gross margin and depreciation. Right? SG&A went from 13.8 to 13.4. That helped. So that offset that. So really, the SG&A kind of canceled the depreciation impact, and it was really the drop in the gross margin from 35.3 to 34.1, which is the primary reason why the operating margin fell. Yes, sir.
Can you explain how depreciation hurts your margin with that depreciation?
Well, depreciation, you know what depreciation is, right?
Yeah.
Okay. So depreciation on this chart is just depreciation as a percentage of sales, and depreciation is a cost. So it's a deduction from your revenue when you figure out your profit. So more depreciation is more of a deduction. So therefore, it's going to lower your profit margin.
Isn't non-cash expense?
Right now, this is the problem, is we're in that twilight zone between the income statement and the balance sheet. And even though it's a non-cash item, it still affects the profit of the firm. So therefore, we do look at it as a cost of doing business, right? And what we're going to talk about when we get to CFI, just more advanced, is we treat depreciation, even though it's a non-cash item, sometimes in valuation, we'll treat depreciation as a cash item because it's a proxy for reinvestment. Okay? And what I mean by this is that if you're losing about 5 cents a year of your equipment, then you probably need to put 5 cents back in to maintain that equipment. Okay? Because if you don't put the maintenance back in, the company's going to fall apart. So as a rule of thumb that we'll often use financially, it's just a rule of thumb, there's always exceptions, is that companies have to reinvest their depreciation to stay in place. Okay? Because otherwise, if you're not reinvesting your depreciation, then your business is going to start to fall apart over time. It's like the example I use personally is buy a car, keep it for a long time, but don't ever do maintenance on the car. Like the car is going to fall apart. Well, same is true with a company. Like if you don't reinvest in a company, it's going to start to fall apart over time. So the same is true when we think about depreciation. Depreciation is kind of like, well, if that's what's wearing out, you probably got to put in about what's wearing out, otherwise your company's going to fall apart. So we will technically start to use this as a cash flow, even though it's not a cash flow, when we start thinking about the performance of a business, if that makes sense. Other questions? Yes?
Can you explain why the effects of the SGA and the depreciation cancel out?
Why they do?
Cancel out, you said?
Well, what I'm saying they're canceling out is because if you look at 2017, and I'll go back to the laser pointer here, so I'm not like drawing all over the screen. So this is 13.8. This is 13.4. So the difference between the two is about 0.04. Okay. So what I'm saying is the lowering of the SG&A should have helped the operating margin by about 0.04. Okay. For depreciation, this is 4.8. This is 5.2. The 4.8 to 5.2 is about 0.04 in the other direction. So what I'm saying is I got a 0.04 benefit and I got a 0.04 worsening. And when I net the two out, that's close to zero, rounding off. Okay. So what I'm saying is this is coincidental. Okay. But when I'm trying to put the story together that you're going to be telling in your minimum 500-word paper and 10-minute presentations, that's what you're going to be talking about is, first of all, let's talk about the magnitude. Some things matter more than others to the change in operating margin. Point number two, why? Why? Why is the gross margin getting worse? Was it a situation where the cost of the coffee was going up and they just weren't passing it along to us? Was it a situation where they had to discount some prices in order to get the volumes that they needed? Like what was behind it? Was it a mix shift and suddenly they're selling a lot more lower priced coffee and food than they were before? But whatever it is, we know their gross margin's going down, and we know that that gross margin going down over time is the primary reason why the operating margin's going down over time, which is a big reason the ROIC is going down over time. Connecting some dots. Question, or are you just scratching? Just scratching. Okay. Yes, sir.
So the SG&A and the depreciation cancel out. How come the change in the operating margin isn't the same as the change in the
Rounding. It's just rounding. Because Excel, in this case, is Excel, and it's doing it exactly. On this screen, it's just doing it to 3 decimal places. But behind the model that actually calculates this, it doesn't limit it to 3 decimal places. I'm just rounding off here. So yeah, you might be 0.01, 0.02 off in some of these, just because of rounding when you add up the categories. Okay. If you don't like to round, when you get your own models, add more decimal places. Okay. All right, but good question. All right, so that's the operating margin second level drivers. The other second level driver we're going to look at is the balance sheet on the productivity side. So what drives invested capital? Well, you just did this. You created a TFI in your last assignment, right? And so what's driving operating invested capital are 3 things, and that's on this chart. 1, it's the spending on working capital. OpWC is operating working capital. 2, it's the spending on PP&E as a percentage of sales, spending on property, plant, and equipment. 3, spending on goodwill and intangibles. That's the intangibles line. You add up these 3 things as a percentage of sales, working capital plus PP&E plus intangibles as a percentage of sales, that equals total invested capital, operating invested capital as a percentage of sales. So this is the sum of these 3. So we said in 2017, it's 25.5 cents is the spending on invested capital to drive $1 of sales. In 2021, it went to 56.6 cents to drive the same $1 of sales, so they're spending more. Now let's explain why. So, working capital. 2017, working capital was negative 5.3 cents. How do you have negative working capital? How is that possible? Yes?
If you have more current liabilities and
Yeah, if you have more current liabilities than current assets, you can have more negative working capital. So in this case, in an operating perspective, the three most important things to operating working capital are accounts receivable, inventory, and accounts payable. Basically, if you have more accounts payable than inventory and receivables, then you can actually end up with negative working capital. Okay? Which basically means you're using your vendors to basically pay your short-term bills. Right? And some companies might rather do that than go to a loan. Because if I get a vendor to pay me in 60 or 90 days, or I can agree have them pay in 60 or 90 days, I can use that money to fund my business without having to pay interest. Right? Now, there's two things that you have to worry about in the real world. 90 days could put some small businesses out of business. So you don't want to drive them out of business. And then number two is they might get pissed off at you and start raising their rates. Because if you never pay them, then they're going to want to get more when you eventually do get paid. So it's a constant negotiation, but nonetheless, all things being equal, more accounts payable lessens working capital. So that's the situation. Starbucks has, because of their size, their vendors, they're pushing up the accounts payable. Okay? So they have negative working capital. When you have negative working capital, that helps your investing capital because you don't have as much investment if you got your vendor supplying it for you for free. Okay? So it went from negative 5.3 cents in 2017 to negative 7.5 cents in 2021. So is that more favorable or less favorable to Starbucks? It went from negative 5 cents to negative 7.5 cents. From a Starbucks perspective, good or bad? Do they have more invested or less invested because of that? They have less invested. They have more negative working capital. They have even less invested themselves. More is on the backs of their suppliers. More current liabilities. So that actually lowers the invested capital of the firm. So that's not the reason why they're spending more cash. They should have saved 2.5 cents of invested capital by going more negative. Property, plant, equipment. This is the stores and the stuff inside them. Okay? 2017, 22 cents per dollar. 2021, 50 cents per dollar. Is that better or worse? Financially. Worse. They're spending 28 cents more per dollar to sell the same coffee. Okay, a lot less productivity on the stores and the people inside. Intangibles, spending on acquisitions. They went from 8.8 cents of goodwill to 13.9 cents of goodwill. Remember, goodwill is not written off. It's only impaired. So it only goes down if the accountants say what you bought isn't worth it. So generally when goodwill goes up, it's suggestive of acquisitions. So what happened with Starbucks? Did they buy somebody? They clearly bought somebody because their goodwill's higher. What year does it look like they made the purchase? 2018, because that's when the goodwill and intangibles went from 8.8 to 18.5. So they had a big jump of goodwill and intangibles in between 17 and 18. So a logical question would be, who did they buy? And if this were your group project, I would expect you to know the answer to that question. Okay? Because that's the other thing, the how and the why, if we do these things. But that's the point. They're now spending more in acquisitions relative to sales, and that is also hurting their invested capital sales. So back to these three drivers, 2 out of 3 drivers are getting worse, PP&E and goodwill and intangibles. 1 driver is getting more favorable, working capital. The worst impact is the PP&E. So PP&E worsened invested capital to sales, like I said, rounding off by about 28 cents. Intangibles 9 to 14, about another 5 cents. That's about 33 cents of worsening. And then they got 2.5 cents of favorable from working capital. Okay, that's what was driving their invested capital sales to go better. Now that we've gone left to right, we summarize our connecting of the dots by going right to left. So in summary, the drop in gross margin from 35.3 to 34.1, which led to a drop in the operating margin of 18.5 to 16.8, coupled with a worsening of PP&E to sales from 22 to 50, which made the invested capital to sales worse from 25.5 to 56.6. Those two combined to primarily drive the pre-tax ROIC down from 72.3 to 29.6. Starbucks was slightly benefited by a lowering of tax rates, going from 33 to 22, but the overall 5-year ROIC fell from 48.3 to 23.2. That is your analysis. Questions? Yes.
I'm a little confused on the operating working capital. You said it gets more negative.
It lowers the invested capital because it's you add the three up. So if I have a bigger number that's negative and I add it up, I get a lower invested capital to sales.
Like logically, but you said that a more negative operating working capital means there's more liability.
So let me ask you this: Do you rent an apartment on campus? Okay. Do you have a car?
Yeah.
Does the car have a loan?
No.
You're fortunate. Okay. Well, let's say do you know somebody that's renting an apartment? Okay. How much might they pay for an apartment in College Park on a monthly basis?
Probably 1,200.
All right, so let's say they don't make that rent payment for 2 months. What happens to the cash?
They have.
And if they're always 2 months behind, can they keep that 1,200 times 2 months? Can they keep it for a while? If they can always stay 2 months behind and not lose the apartment. So that's the point. That's what Starbucks does. So Starbucks skips a couple of rent payments. They use that $2,400 to buy coffee because their landlord lets them get away with it. Now, if their landlord didn't let them get away with it, it could cause problems for Starbucks. Okay? But in the real world, companies can get by with paying their suppliers in 60 or 90 days, and they do. And they'll use that cash to run their business. Here's the difference. You go to a bank, you borrow $2,400, they're going to charge you interest every month. If you have a supplier who grumbles but lets you get away with it, they don't charge you interest every month. That's why we call it free financing. All right? So that's the point. Starbucks is basically skipping some payments to their coffee vendors or lengthening the time that it's paying them, taking that cash and using it to do other stuff. More negative working capital, less invested capital tied up in the firm. Other questions? Now it's time to ask. Yes?
More pertaining to the homework. Did you say that for the homework we're also only doing first and last year, or?
I'm saying in class today we're doing first and last year, and on your first homework assignment that's going to be due Monday, I'm probably going to say primarily first and last year, but your second homework assignment, which will repeat this one, is going to be all 5 years, and your group project's going to be all 5 years. Okay? And Wednesday, when we come back, we're going to practice more, talking through the 5 years. But this is one of the 2 assignments you're going to have to do. Okay? So very quickly, let's go to another company. So here's a company called Target, also known as Target. Okay, guys, again, I want to go to companies you're familiar with. All right, so this is 21 data, 22 is just coming out, so I haven't updated the slides because it just literally came out in the last week or so. But the point is, let's look and see what's happening to Target over the 5 years. Just another company. Okay, same process. Okay, so in 2017, end of year ROIC 13.5. 2021, 20.5. Okay, so it got better. Everybody see that? All right, driver 1, tax rate. Did tax rate help or hurt Target over the 5 years? Did it help or hurt their ROIC over the 5 years? When the tax rate went from 32.7 to 21.2. It helped. So one of the reasons why Target is doing better is because it's paying less in taxes. Right? Now, Starbucks would have been doing better if their underlying performance was better, but both companies benefited by lower taxes. Okay, that's helping their ROIC. Now let's look at the underlying sales at the actual Target stores from operations. So when you walk into a Target, you buy something, on a pre-tax ROIC in 2017, they were making 20 cents. By 2021, they were making 26 cents per dollar of investment. So that ROIC improved. Okay, they're doing better on their stores. Okay, the question is why? Driver 2. Are the margins better on their products? So when you buy the product at Target, are they making more or less than they did 5 years ago on that sale? Actually making slightly less. They were making 7.2 cents per dollar in margin in 2017. By 2021, that fell to 7 cents per dollar. So slightly less. So that's not why their ROIC went up. Driver number 3, invested capital to sale. To generate $1 of sales in 2017, they spent 35.7 cents a balance sheet. To generate the same sale in 2021, they spent 26.8 cents a balance sheet. They're spending less to sell you the same products. That's better. They got more efficient. So if I really look at what's driving Target's pre-tax ROIC up, it's all productivity. The margin was pretty flat, slightly down, and it was the big improvement in productivity of the balance sheet that drove their pre-tax ROIC. But 2 of the 3 drivers, tax rate and productivity, helped their ROIC. Margin was about flat. Everybody with me so far? Right? Now the margin stayed flat, but did anything change on their income statement? Gross margin went from 32.6 to 31.9. So the difference between price and cost of goods sold actually went down. They're actually making less price versus cost of their merchandise over the 5 years. Okay? But if you look at their SG&A, they went from spending 22 cents to 22.3 cents. That was flat. So why is Target making a little bit lower operating margin? What's the primary reason? It's the gross margin fall. Right? And then depreciation also worsened. They went from improved 3.3 to 2.7. So really, why'd their operating margin fall? 100% of it is gross margin. That was offset by lower spending, by flat spending in SG&A and lower spending on depreciation. Second level drivers for the balance sheet. Why'd the productivity get better? Why'd they go from 35.7 to 26.8? Working capital went from basically 0 to 0.5 negative, 0.05 negative. So they basically got about half a cent in working capital improvements. That lowered their invested capital, just like Starbucks. Okay? More liabilities. PP&E to sales went from 35.5 to 31.1. That means they're getting more sales out of their stores. More store productivity. Intangibles, 0 to basically 0. They don't do a lot of big acquisitions. So unlike Starbucks, which we know bought somebody pretty big, Target didn't really buy. They don't do big acquisitions. Their growth is pretty much organic. So that's the point. All of that driving of productivity, primary reason, PP&E to sales 35.5 to 31.1. So again, what's my story of Target when I go the other way? Highlight it. Target story over the last 5 years is a productivity story driven by the improvement in PP&E to sales primarily, 35.5 to 31.1, which is the primary driver of invested capital to sales going from 35.7 to 26.8. Okay, which coupled with a flat operating margin over the 5 years led to a pre-tax ROIC improvement that went from 20 to 26%, coupled with a lower tax rate that went from 32.7 to 21.2, which improved their after-tax ROIC from 13.5 to 20.5. Notice I'm using numbers consistently and throughout, not generalizations. That's the ROIC tree. Here's Dollar General. Anybody want to take a shot at the first level drivers? Any brave soul in here? Everyone's like, nope, I'm not brave. bring one of those little cush balls. And if I throw the cush ball and it hits you or you catch it, then you have to talk. That way, if it hits you in the face, nobody gets pissed off. Won't hurt too bad. But I don't have a cush ball today. All right. Thank you for being a brave son. I don't have to throw a cush ball.
So clearly the tax rates through the 2017.
Whoa. You're going too far. Start with the ROIC and then get to the tax rate.
So their ROIC from 2017 is 16% to 2021 is 11.6%.
Okay.
And then look over the pre-tax ROIC and the tax rate. Clearly from 2017 they got 19.3%, and 2021 is 21.7%. They are spending more tax shield, and
So that's hurting their ROIC.
yeah, that's
Okay.
hurting the ROIC.
Okay.
And then looking for the operating margin from 2017 they got 0.086, 2021 is 0.094. The operating margin is increasing, and look over for the gross margin, SG&A and depreciation. It seems like their gross margin is clearly from 0.325 to 0.335, which is increasing a lot. And their depreciation is, and their SG&A is constant, remain constant. And their depreciation, they're costing more for their depreciation, which is going to hurt for the operating margin, which is, we can see the gross margin is the main drive for bringing their operating margin up.
Okay. So, two things. Correct as you were making the connecting of the dots. My recommendation, though, to the rest of you is she went all the way through the income statement drivers. It might help you, because we're trying to explain changes in ROIC, to break out first level drivers and second level drivers before you get to the second level drivers. Because what you really want to make sure is, why is that pre-tax ROIC at Dollar General getting worse? Okay? And it's both margin and productivity drive that. So when you go all the way through to the income statement, it just becomes a little less clear about why it's eventually going to change the overall ROIC. So everything she says is correct. I'm just going to suggest a little bit of reordering as you practice doing this. Now, when you get advanced, what she did is perfectly fine. But we need to learn how to use these statements first. So I would recommend first level drivers, then second level drivers. But she connected the dots correctly. And those are the types of analysis that I eventually want you to do. Does that make sense to everybody? Questions? Okay. In the interest of time, statement number 2, CFI. So I'm going to go back to Starbucks to talk about CFI. CFI is cash flow. Okay? So again, 4 sections, 4 buckets of cash flow. Operating cash flow, non-operating cash flow, debt cash flow, equity cash flow. The nice thing about these CFIs is I'm going to give them to you already converted. You don't have to convert the real company CFI. As a matter of fact, in the valuation model that we're going to start on in a couple of weeks, the valuation model will auto-convert real companies to CFIs. Okay? So that'll help. But nonetheless, we got a converted CFI, 5 years worth of data. The difference is there's a total column which just adds up the 5-year dollars. These are all in dollars. Okay? So, for purposes of the training wheels, I'm going to focus on the total column. Okay? But just like in the other analysis, you're going to have to care about what's happening in between. All right? So, let's start out with the total. When you do a CFI analysis, the first thing you look at is free cash flow. That's where you start every time. Because that number is going to tell you how the rest of your analysis is going to go. If the free cash flow is positive, you're generating more cash than you spend from operations, then the way your analysis is going to go is positive free cash flow, where did the money go? In the other 3 sections. If the free cash flow is negative, that means I spent more than I made. Where did the money come from to fund those losses from the other 3 sections? So free cash flow is telling to your analysis, because if positive, where'd it go? If negative, where'd it come from? That's kind of how we're going to frame the analysis. So for Starbucks, the free cash flow was positive, total over 5 years, $3.2 billion. Okay, everybody see that? Now, when we go through the free cash flow section, 2 parts of free cash flow. gross cash flow, how much cash they generated selling coffee from the income statement, profit plus depreciation. Over 5 years, $20.99 billion of gross cash flow. Over 5 years, gross investment in working capital and capital expenditures, $15.96 billion. That gave them free cash flow before goodwill, before spending on acquisitions, $5 billion of free cash flow before acquisition premiums. That represented a 76% average investment rate. Investment rate is gross investment divided by gross cash flow. All right? So Starbucks is putting in about 76 cents per dollar of their profits back into the business. Okay? Now Starbucks is also spending $5 billion over the 5 years in acquisition premiums. $1.79 billion in acquisition premiums. So out of the $5 billion of free cash flow before goodwill, they ended up with total operating free cash flows about $3.2 billion. Okay. Now the other number that's going to be important here is, and it's a ratio, it's the ratio of CapEx to depreciation. Right? And I mentioned this a little bit earlier when the other student asked the question. And I said, we assume that CapEx should equal depreciation if you're just trying to maintain what you got. It's an assumption we make in finance. If you're spending more than your depreciation with CapEx, that suggests you're trying to grow. Okay? Because I'm not just replacing, I'm building new. If you're spending much less CapEx than depreciation, then it suggests that you don't plan to grow, because I don't need any more stuff. So there's a short-term telegraphing of a company's growth plans that can be looked at in the ratio of CapEx to depreciation. Okay, so let's look at Starbucks. What happened in 2021? What is the ratio of CapEx to depreciation? It's 115%, right? It means you're spending slightly more than the depreciation. What about 2020? 600%. So it looks like in 2020, they expected to expand a lot. And in 2021, they're not expecting to expand nearly as much. So I would say they're looking for some tepid growth in 2022, but not huge growth, because they would have spent more in their stores to get it. Does that make sense, everybody? So that's the other ratio that we kind of look at as a telling number for a company, right? Now, when we go back to the free cash flow, we got $3.2 billion of free cash flow. What did they do with it? Well, to get to CFI of about $8.5 billion, how did they get from $3.2 billion of free cash flow to $8.5 billion of CFI? Well, first thing they did is they got rid of and got cash from a bunch of non-operating assets. So they generated $6 billion, $6.3 billion, getting rid of non-operating assets. They also generated $3 billion of gains when they sold those non-operating assets. So that generated about $9 billion worth of cash. They took 4.2 billion of it, and they put it into excess cash. So 6, 9, minus 4, 5, that net 5 is how they went from 3.2 billion of free cash flow to about 8.5 billion of CFI. That's what happened in the non-operating section. Okay? So they got 8.5 billion to give to their debt and equity holders. What did they do? They paid out 1.1 billion of after-tax interest expense. Okay, got to pay interest on the debt, makes sense. So the 8.5 billion, 1.1 billion went out to pay interest. They borrowed $20 billion of new debt. Now, this is a question I always like to ask on one of the exams. Did Starbucks need to borrow that debt? Did Starbucks need to borrow $20 billion? Yes or no? And there is a correct answer over the last 5 years. Did they need to borrow $20 billion worth of debt? No, they did not. Why not?
Because they have a positive CFI.
Because they have a positive CFI and a positive free cash flow. They're generating more cash than they spend. Why do they need to borrow more debt? Let's hold on to that thought. Why would they borrow $20 billion if they have all $8.5 billion to pay out? Let's keep going. Starbucks then spent $8.9 billion, about $9 billion on dividends over the 5 years. And then Starbucks bought back $21.5 billion of their own shares. So 21.5 plus 9 is about $30.5 billion of payout to the shareholders. How do you pay out $30 billion to shareholders if you only got $8.5 billion of cash to pay out? You borrow a bunch of debt. That's the point. That's why they issued the debt. They issued the debt to buy back the stock. They made enough cash to pay the dividend, but they wanted to continue, quote unquote, rewarding their shareholders. So it's clear that that cash that rewarded the shareholders came from the banks. All right? And this is what's going to be important for us to distinguish as valuation practitioners. Because is that sustainable? Is it sustainable for them to keep paying out share repurchase at this rate? No, it is not, because eventually the banks are like, I'm not going to keep lending you money to buy back your stock because you're not going to be able to pay me back. So don't get me wrong, I like cash. And I'm sure the shareholders love getting the cash, and it probably juiced the earnings per share by reducing the share count. But that's not a long-term sustainable stock buyback. Like the sustainable stock buyback is if they had $20 billion of free cash flow and then they bought back $20 billion worth of stock. That they can recur. So this is back to the point of the valuation. Like when we value companies, we start to look at that payout. How sustainable is that payout? And it's not going to be more than your free cash flow over time. It just can't be. So that's the point. What's your free cash flow? What are you paying out? Starbucks is choosing to pay out a whole lot more than their free cash flow. Now, again, a lot of companies did this because we were in a time of cheap money. Why not borrow at 2 to 3% long-term interest and pay it out to the shareholders? The banks are willing to give you the money. Take advantage of that. Those days are gone, by the way. Yes, sir.
So essentially, are they trying to change up their capital structure to make it cheaper?
You could argue that this could be a change in capital structure, levering more debt. You can argue that they thought, well, gee, our stock price is undervalued, so here's a way to start propping it up. But I'm telling you, if I'm a professional and I'm really looking at what's going on, I'm seeing that they're not buying back the stock because they're making more money. I see that they're buying back the stock because they're borrowing from the banks to give me that money. Well, that's different than if the business was improving and that's the reason why you're buying back the stock. So this is what I'm saying. We're going to take a little bit more sophisticated approach than a headline or a press release that a company's going to give as to what's the cash flow and where is it coming from. So as I said, they're rewarding their shareholders with $30 billion over the last 5 years. But I'm also telling you that $22 billion of that came from the banks. Didn't come from their improved operations. Does everybody see that? Okay. And I'm not going to make a good or bad judgment. It is what it is. And then we can make our interpretations. Questions, comments about that? So very quickly, as my battery is about to die here. So let's look at the CFI for Target. Okay, similar process. Free cash flow, $18.9 billion, free cash flow. Okay, how'd they get that? Over 5 years, $31.1 billion in gross cash flow for the income statement, $11.8 billion gross investment in CapEx and working capital back into the balance sheet, average reinvestment rate 38%. That gave them $19.3 billion of free cash flow before acquisitions. They spent about $390 million on some teeny tiny companies that they bought, leaving them with about $18.9 billion of operating free cash flow. Right? They then had $15 billion that was available of CFI to pay out because they took primarily $4 billion of the $19 billion of free cash flow and they put it into excess cash, leaving them with about $15 billion to pay out. They basically paid $2.7 billion out in interest. They borrowed $2.3 billion worth of new debt, not nearly at the scale of Starbucks. They paid out $6.7 billion in dividends, repurchased $9 billion of shares. So that's about, round off, $17 billion of shareholder reward. Okay? They had $15 billion to reward the shareholders of CFI. They paid out $17 billion to the shareholders. Where'd the other $2 billion come from? They borrowed it with the debt. Not to the scale of what Starbucks did, but nonetheless, they did pay some out. Okay? Again, I'm skipping the intermediate years. We care about each of the years too, just focusing on the total to understand the basics of the analysis. And if my battery doesn't die, really quickly what happened at Dollar General. So at Dollar General, they had negative free cash flow over the first 5 years, negative 1.7 billion, because they had 12.9 billion of cash from the income statement, and they reinvested 14.6 billion back in their balance sheet in working capital and PP&E. They had a 113% reinvestment rate. So they were investing more than they were making, probably because they're trying to grow, right? Because their average CapEx and depreciation rate over the 5 years was 566%. So the Dollar General stores were starting to pop up everywhere as they were doing a nationwide expansion. And they continue to want to expand in 2022, given their CapEx to depreciation ratio in 2021 of 266%. That negative free cash flow, negative 1.7 billion, became negative 1.5 billion of CFI because they did take 87.8 million of cash and increased their excess cash, and they also bought some non-operating assets that cost them 65 million. But they still needed to borrow or sold off some non-operating assets that generate 65 million. And so, decreased their excess cash by 87.8 million, which got their, increased 87.8 million. No, decreased 87.8 million and sold off 65 million, which got them to negative 1.5 billion of CFI. It's even harder to remind myself of the signs we're looking at. What'd they do? They borrowed $11 billion worth of debt. Now, I already knew they had to go find some cash because they had negative free cash flow. Why'd they borrow $11 billion worth of debt? Because they simultaneously bought back $7.8 billion worth of shares, paid out $1.6 billion of dividends, while expanding all of their stores, which cost them more money than they generated. So their financing wasn't just to reward the shareholders, it was to reward the shareholders and to fund a massive expansion in their stores. Everybody see that? Questions? Okay. This is CFI analysis at a high level. Again, we care about the intermediate years. We went through the ROIC trees. On Wednesday, we're going to practice. I'm going to just give you more companies. I'm going to hand them out. You guys are going to tell me what's going on. Your next homework assignment, homework 6, we'll be doing these. You'll do an ROIC tree and a CFI of a company that I will give you. We'll have 2 practices and homework, and then you're going to do a group project on this for Parker Hannafin. That's what's coming up. TAs have office hours. If you have questions about any of this, no practical homework between now and Wednesday. I'll just see you guys in class on Wednesday for practice. All right, have a good day. And this has been recorded, so I'll be posting this online.